We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dave Kranzler from investment research dynamics.com. He's also the author of the Mining Stock Journal and Short Sellers Journal. Thanks for joining me today, Dave.
Thanks for having me on again, Tom. It's always a pleasure.
Great to have you back as well. So recently you wrote an article entitled, "Are you prepared for the next big move in gold and silver?" And in it, you mentioned that the entire precious metal sector is starting to convey bullish signs, and that silver in particular is potentially explosive. So what are some of the factors that you're seeing that really explain this? Wow,
I really wrote that? Sounds like I should read it. That's a good question, and you never know for sure when a bottom is in place, or when the next rally starts until you're already into the next rally. I mean, it's people who claim that they can pick tops and bottoms. There's a lot of guys out there that sell their technical research on that. I mean, maybe they get lucky once in a while, but anyone who says they can, they're even 50% accurate with calling the bottom in any sector of the market is either delusional or just outright lying. But there's, over the last 20 years, there's some indicators that I look at, and sometimes they work, sometimes they don't. I mean, I still feel like, so we had about a 4.5 year bear market in the sector from 2011 to late 2015. And then December 2015, I think we started our next bull cycle. And the bull cycles, at least the first big bull cycle we had since the big bear market that started in 1980 ended in late 2000, early 2001. The big bull cycle there, I mean, there were mini cycles in between, but that one lasted 11 years. And obviously the monetary and fiscal backdrop, and even the geopolitical backdrop, are even more powerful now in support of gold and silver fundamentals than they were between 2000 and 2011, especially the money printing, also known as fiat currency devaluation. So, and the cycles, a lot of the cycles, or part of the cycles that we've seen, when you go through a big rally and then a big sell-off, we had a big rally from March 2020 until August 2020, and it was a sharp rally. I mean, gold went from 1,200 to almost 2,100, and a lot of people piled into the sector. And so what we're seeing now is a pullback from that big move, and it's been about an 11-month pullback. And I personally think that it has either run its course or is close to running its course. And some of the things I look at are, for instance, in the Commitment of Traders report, the Comex banks have reeled in their net short position by quite a bit. The hedge fund category, which is the primary, they're the primary long side to the banks shorting Comex futures. They've been unloading a lot of their long position and reducing their net long position. And that's always, and I don't know if that cycle has completely washed itself out yet, but if it hasn't, it's getting close. Another thing that I look at, and there's obviously a difference between the physical gold market and the paper gold market. The paper gold market being futures, LBMA forwards, derivatives, OTC derivatives, leases, unallocated gold mechanisms. And that's kind of what I call the paper gold market. It's the phony gold market. And then there's the real physical gold market, which is primarily driven by the Eastern Hemisphere. In fact, the Shanghai Gold Exchange is now considered the physical gold, the primary physical gold hub of the world. And so as part of that, India is a big driver of what happens in the physical gold market, because in any given year, they're the largest or second largest importer of physical gold. And that's not gold that just sits in vaults in London. It's gold that has to be delivered into India. And India was dormant for, say, the last 8 to 12 weeks because they kind of reshut down their economy and their system because they had a big increase in virus infections. And I guess deaths may or may not have gone up depending on what report you're reading, what the source is. But at any rate, so they had stopped importing gold for a period of time. And that gave the banks, it made it easier for the banks to use phony gold to push the price down. And as they were pushing the price down, they're covering their shorts. Well, India has started waking up. They've started reopening. Just last week was the first time from the data that I see every day that they started importing gold again, and in a, not yet in a significant amount, but they reopened their gold importing mechanism. And China's been kind of dormant also, at least the visible side of China. We never know what the central bank is doing. But we're starting to go into the seasonal period of the year when India imports the most amount of gold that they import during any part of the year. And China also to a lesser degree. And as India starts ramping up its gold imports, first, I think it'll make up for lost time over the last 2 to 3 months that they haven't been importing, because that's been their pattern. And second of all, they're going to have to import a lot of gold for their holiday season, which really runs from kind of early September to late December, early January. So I think we're going to see, if nothing else, I think we'll see the price of gold get pushed higher from a lot more physical demand coming in from the Eastern Hemisphere. And then there's sentiment indicators. The easiest one for me to read is my subscriber base. So what happens is when the market starts to run up, I start getting a lot more new subscribers. And then as the market starts to peak, that's when I seem to get the most new subscribers. So like I had a ton of new subscribers in July 2020, August 2020, right as the market was peaking. Well, starting in February, March, all of a sudden, a lot of those new subscribers started canceling. And for a while, cancellations were outpacing new subscriptions. And I'd say over the last couple of weeks, it's kind of leveled off. And over the past week, I've had more new subscribers than cancellations. So, and my subscriber base, there I do have some institutional investors that are subscribers, but it's primarily retail investors, because that's who invests in the junior mining stocks. That's what I invest in. And so I think it's retail usually is a pretty good barometer of market sentiment. And so I think the bearish market sentiment in the sector that we've seen, I mean, really since last August, but especially in the last month or two, I think that's bottomed out. And I could be wrong, who knows? But there's enough of these variables that seem to be coming together that I think, if anything, I think it's going to be harder for them to push the price lower. It may take a while before we move higher. And you can even see that on the chart. So I pulled up a chart here. If you just pull up a 1-year chart of gold, and in March and in early April, the gold, I'm using the continuous gold futures contract on stock charts, it had a double bottom at 1675. And then it moved up off of that, sold off again starting in early June. And then it had a double bottom at, just say, 1770. And we've been moving up nicely since then. And I've just noticed, because I watch the futures, all day long, every day. And it just seems like right now they're having trouble keeping gold. I mean, they've been able to push it below 1800, on a intraday basis, but then it seems to be bouncing back up over 1800. And today's a good example. I mean, when I woke up, gold was trading, and I checked the market, gold was trading at, 1804, 1805. And I went to get some coffee, and I come back and I was like, whoa, it's back down to 1792, like, a broken elevator cable. And it's actually popped back up, and it's it's trading back above 1,800 now. So, it's just, it feels like gold and silver are percolating, and especially silver.
Mm-hmm. So I want to go back to something that you were talking about earlier, Dave, about the commitment of traders reports. When do you find them useful, and when are they, more useless to you?
This is a controversial view of mine, because there's some analysts out there that base their entire subscriber service on the COT report and the analysis of the COT report, and the idea that the commitment of traders report is 100% honest, that it is what it is what you see it is. And I disagree with that, because the banks control the Comex, they run the Comex, all the reports are produced by the banks. And if the big banks are honestly and ethically reporting the data that goes into the COT report, it's the only business line at any of these banks that they're doing reporting honestly, right? They don't report their financials honestly. They don't report their business activity honestly. So why would they report the commitment of traders, the data that goes in the commitment of traders report honestly? And that goes for the warehouse stock also of gold and silver, the vault stock. But I mean, that's not to say that it's a complete fraud. I mean, I think it moves in trends, the commitment of traders report, with the open interest. And I think they do fudge positions. I mean, JP Morgan got nailed for fudging silver contract positions. It was stuffing silver positions that were supposed to go into the bank's house account, stuffing it into the other reportables category. I think it was 2012 or 2014. I forget. Look it up. And they were wrist slapped by the CFTC for doing that. But a $650,000 fine's not going to stop JP Morgan from continuing to do that, right? I mean, it's the cost of doing business. So, but I do think, and so to get back to your question directly, I do think that when you get the open interest at extremely high levels or extremely low levels, that's when I start to pay attention to commitment of traders reports and the way the hedge funds or the managed money and the commercials, which are primarily the banks, some industrial users in there, and some legitimate hedgers. I pay attention to what they're doing in terms of collapsing their net short position, and I pay attention to what the hedge funds are doing in terms of either expanding or collapsing their net long position. And at those extreme levels, that usually seems to be when the market turns. So again, we're at a relatively low level in the open interest. The net short position of the banks, it could go lower. It usually when we start to have a sustainable move higher, the net position of the banks is net short position is lower than it is now, but it doesn't have to be. And same with the hedge funds. Usually at a bottom, the net long position that they have is a lot smaller than average, and we're not there yet. But again, it's really more of an art than a science at looking at it and interpreting it and trying to base market decisions on that. And that's why I just kind of let the market tell me what to do, and I don't try to get the absolute bottom of the market and load up there, and I don't try to top tick and time the top. So if I can catch the middle 60% of any given move, I'm going to end up long-term successful as an investor. So right now, when I look at the chart and some of these other variables, it tells me that there's a much higher probability that we'll move sideways or higher from here rather than see new lows, where the new low for me would be defined as what we saw in March and April, just like the low in March 2020 was around 1,200 for gold.
So, of course, we're speaking here in the first half of July. We just saw the Basel III regulations, supposedly come into effect, and as we saw at the end of last week, the LBMA has been exempt from these regulations. So, can you explain to us why this is and why they have received this exemption?
Yeah, well, the Basel III, that's another controversial topic, and I've been skeptical all along that it was going to do what some people were thinking it might do, which would cause gold to do a moonshot right away. And it's been the provisions of Basel III went into effect for the EU banks at the end of June. I think for the UK banks, I don't think it goes into effect until the end of July, maybe. I forget. And I think the US maybe the end of this year. I don't remember the exact. It's to me, it's not that important, because the effectiveness of Basel III in doing what it's meant to do rests on whether or not each country, each governmental system decides to enforce the provisions. There's nothing in there that gives the BIS the power to completely enforce them. So we'll see what happens. I think they basically, in terms of what some people think Basel III will do, which is blow up the unallocated gold market in London and New York. I've been skeptical of that, because I don't know why the banks would put anything into motion that would harm them financially. Because if Basel III was applied, down to the punctuation marks to the banks, that's what it would probably do. It would force the banks to go out and start accumulating real physical gold that they have ownership title to. And that's your tier one gold based on the Basel III provisions. And at some point, it would force them to consolidate or significantly reduce their unallocated gold positions, because otherwise they have to reserve, I think, 43% of capital against the unallocated gold positions. So, and that was the idea that I think people were looking at and saying, oh, this could really push gold higher. Well, yeah, in an ideal world, that's what would happen. But we've already seen, the UK has lifted its skirts. It said, okay, banks in London are exempt from these provisions. So that means it just goes business as usual for these banks in terms of the unallocated fractional bullion system that they're perpetrating there. Mm-hmm. And I expect the U.S. to do the same thing, is exempt the banks that are involved in gold trading, the bullion banks.
And part of their wording for the London banks in that article was that gold is liquid enough not to need additional liquidity buffer for clearing and settlement and short-term transactions. So would this be true if they were talking about actual gold and not derivatives of gold?
It absolutely would not be true if they're talking. The reason why there is a derivative / unallocated gold market is because it was a way for the central banks and the sovereign policymakers to divert institutional fund flows that otherwise would go into physical bullion in allocated form, and let them have this unallocated derivative mechanism that they can invest and index the price of gold. And that market is very liquid. I mean, the banks, you just look at the Comex as a good example. They just print up as many contracts as they need to when the market starts moving higher, and they feed them out into the market. Well, they don't have all that gold in the vaults. They don't have anywhere near close to the amount of gold in the vaults that's represented by the open interest outstanding on the Comex. So, yeah, of course, Basel III would smash the liquidity of the unallocated derivative gold market, but that's not the real gold market. And just to circle back about my assertion on the purpose on why the unallocated fractional bullion system came about and the derivatives, there's letters now that were declassified several years ago. GATA has them on their website in their archives. Letters between Henry Kissinger and his financial advisors, and it's exactly what they were talking about. They're like, and this was right after Nixon closed the gold window, and they said, look, we got to find a mechanism that diverts institutional investor money into non-physical forms of gold. And that's how gold futures came about. Gold futures didn't start trading until 1974, and they were developed specifically for that purpose. So, people who think this is conspiracy theory are coming from ignorance, because they don't know what the facts are and they don't know the history. So, that statement is absolutely right. If Basel III was enforced to the letter, it would destroy the derivative. It would destroy gold derivative trading. Maybe not destroy it altogether, but it would certainly take a wrecking ball to the liquidity, and that would be a good thing in order to bring real price discovery to the real gold market, the physical gold market. I just thought of a good way to illustrate this point, and this will be quick. So imagine imagine two markets. You've got the derivative gold market and then the physical gold market. Okay. So if China made an announcement and said, hey, we're looking for 100 tons worth of paper gold, of derivative gold, show us your best offer. Well, bullion banks would be jumping out of their seat to offer them paper gold. If they came out and said, we want 100 tons of physical gold and you have to take that from your vaults and deliver it to us on a timely basis, you'd see that trade would happen at a much higher price than the market price that we're observing right now. Because physical gold is not anywhere near as liquid as the derivative gold that trades every day in huge volume in London and New York. And so that's what they're talking about in terms of ruining the liquidity of the market. They're talking about the fake paper gold market. I say let it be ruined.
Yeah, it seems there's a huge disconnect in the, just looking at the physical premiums price over what's considered spot, right?
Oh, absolutely. I mean, Indians are paying, I'd have to run the calculations, but they're paying close to $200 an ounce over the world gold price, where the world gold price is what you see at the London Fix, twice a day.
Mm-hmm. Yeah, it's just crazy to think about that disparity between, exactly as you're saying, the paper market and the actual physical market.
Right.
So, Dave, I'd like to turn a little bit to kind of the more mainstream equity markets. We've seen a greater and greater number of speculators entering the markets with meme stocks and just everybody jumping into these markets. So, is there another time in history that we can point to that would be comparable to this time?
I mean, in terms of U.S. history, you look at the dot-com bubble, the tech bubble, in the late 90s into early 2000. That's in terms of the degree of excess speculation, it's comparable. And then the Roaring 20s, another period when it would have been comparable. And obviously, both of those periods were followed by a massive crash in the stock markets. And the attributes of the type of speculation are very similar also, including the use of margin and debt. The difference between the current period and the two previous periods I mentioned is that the scale of what's happening now is many multiples larger than it was in 1929 and 1999. In fact, I read an article last week. Retail investors are not only getting maxed out on margin debt, a lot of them are taking out personal loans and dumping it into the stock market. And that's making the stock market completely radioactive.
And that can also play a factor in how quickly things unwind when people start to see their accounts drop and they know that they have margin and loans to be able to, or to have to pay back, right?
Well, yeah. And I was just talking about this earlier this morning with someone in terms of, why can't the Fed just keep printing money and hold this up forever? There's going to be some trigger event that causes a flood of selling, and the Fed's not going to be able to hold that up. I mean, we saw something similar to that starting in late March or late February 2020. So, and the market started tipping over a couple weeks, 3 or 4 weeks before there was actually an official, lockdown period globally. So, and a lot of the same indicators that accompanied the run up in the stock market into late February 2020, we're seeing a lot of the same indicators now. And I just think at some point, like I said, there's going to be something that triggers a flood, an avalanche of selling from institutions, mainly hedge funds, because they're a lot of those are over their skis in terms of leverage, and particularly retail. So at some point, we're going to see another bloodbath. I just have no idea when.
So is it possible that as everybody's talking about inflation right now, what do you think, Dave, could be, let's say, the possibility of seeing a deflationary collapse here? And what would that look like instead of the inflation that everybody's talking about right now?
So my whole problem with talking about that topic is there's the inflation that is commonly referenced to in the mainstream media, et cetera, is price inflation and financial asset inflation. The true definition of inflation is when the central bank prints money at a faster rate than the economic wealth output is expanding. So it's essentially, simplistically, you have more dollars every day chasing a lesser relative amount of output, wealth output. Mm-hmm. So, and that's the dynamic that causes price inflation. And really, since 2008, the money that the Fed has been printing has been channeled into financial assets, not just the stock market. I mean, junk bonds, CCC junk bonds are trading, in some cases, inside of 400 basis points over the equivalent treasury. And to put some relativity on that, when I was trading junk bonds in the 90s, the average CCC paper was trading between, say, 15 and 20% over the relative equivalent treasury. And that spread is supposed to reflect the relative risk of a junk bond issuer, and specifically CCC guys. If you're rated CCC, you got a better than 50-50 chance of hitting the wall in the next couple of years. So, and that's what, so if you've got, I don't know where the 5-year treasury is, 2% or something. If you got a 2% treasury bond and equivalent maturity CCC paper, so you're getting paid 6% to hold that piece of paper, and yet the odds of that company still being solvent in the next 2 years is greater. Being solvent is less than 50-50. That's not a good risk return equation, at least for me. And to me, that's one of the ultimate signals that speculation has just run completely rampant, and it's all been fueled by the Fed's money printing. So since the virus crisis began, now we're starting to see a lot of what the Fed is printing being transmitted into price inflation. So anyway, to get back to your question, what the deflation that is being referenced, and the deflation that is the evil thing, is going to be the deflation of the value of financial assets, stock market, bond markets, even homes, housing prices. I mean, this housing bubble that we're in is different from the one that we saw in the early 2000s. That one was a price and volume bubble. This one is more of a price bubble, and the prices are at a record high. And I say houses are financial assets because 70 to 80% of all home buyers use a mortgage to buy their house. And a large percentage of those are using a mortgage with less than 5% down. And a mortgage is a financial asset. So essentially, if you don't have the ability to take down that financial asset to purchase your house, and really it's just to move into a house that you can say is yours, even though the bank still has title to it, then housing prices don't go up the way they've gone up. I mean, the Fed's been dumping $40 billion a month into the housing market since June or July of 2020. And it initially dumped a large portion of the $3 trillion that it printed back then into the mortgage market. So of course there's a housing price bubble, and that's what's fueled it, is the Fed's money printing. So when the way that I interpret it, when we're not going to see price deflation, and we will at some point after a complete economic crash, we're not going to see price deflation. If anything, as long as the Fed keeps printing, we're going to see a lot more price inflation.
Mm-hmm. So when we look at these tools that the Fed has to implement its monetary policies, how do the repo and reverse repo programs fit into this puzzle, Dave? As we've seen, the reverse repo program has basically exploded to levels that have never before been seen. So what is this forcing the banks to do with their balance sheets?
So back in September 2019, the Fed started doing its repo program, and that was, I forget it. Oh, they said, well, the plumbing in the banking system's a little bit clogged up. Well, no, the signs that the banks were starting to become illiquid you could start seeing those as early as August that year. And the Fed's, and as evidence of that, the Fed's overnight repo program quickly escalated to weekly and monthly and longer repo operations, right? I mean, that was basically QE light. And then in March 2020, the virus crisis gave them the cover to print $3 trillion all at once. And that was probably what was needed to help monetize illiquid bank positions. And what we're seeing right now is there's a ton of excess liquidity in the banking system. And I mean, there's several reasons why they're doing these reverse repos, but I look at it as kind of the mirror opposite of what happened in the fall of 2019. Is the reverse repos are taking and sucking out on an overnight basis, $750 billion every day. But it doesn't remove that money permanently. It kind of holds it in suspended animation, because the way the repo operation works, the Fed offers out treasury collateral and mortgage collateral as for banks to borrow, and they put up their cash on their balance sheet as collateral for that, and it happens overnight. And then the next day, the reverse repo unwinds, and then they do the reverse repo again. And so they're kind of rolling forward in suspended animation, this $750 billion of excess liquidity. And I believe there's two reasons for that. And like I said, there's probably a lot more complicated reasons, but to me, it's an Occam's razor situation where if they were to leave that liquidity into the banking system, I think they'd have trouble holding up the Fed funds rate above zero. I think it would go below zero. And it would also cause money market funds to break the buck, which they're allowed to do now, but it optically looks bad and it tells you there's something wrong in the financial system. And then I think the second reason is they're trying to keep that liquidity from spilling over into the real economy and transmitting into even higher price inflation. Because that's what people see, that's what people associate with inflation, is price inflation. The event that causes that's already happened. The money's already been printed. And so I don't know how high the reverse repo program is going to get. I don't know how long it'll last. But in my opinion, in my view, it tells us there's something really bad going on behind the Fed's curtain in the financial system, especially the way that it escalated so quickly, the reverse repo program.
Yeah, absolutely. There's a very dramatic chart I can dig up and we can put on the screen here for viewers, and it's just an incredible spike from near zero levels, right?
Right. That's exactly right. And I sent you that chart that shows commercial industrial loans over the last year from banks, and it's gone straight down after July 2020. You had a big uptick in business borrowing from banks to expand their businesses and whatnot. And then
to make sure that they're getting, that they were going to be able to get through the pandemic, right? They were all taking out loans because they were available. And that was my next question, is how does this really affect the monetary velocity right now?
Well, I mean, it's been a while since I've looked at the velocity chart, but I mean, and you see all kinds of crazy explanations, or that it's irrelevant. Well, it's not irrelevant. When the velocity of money gets down to as low as it is now, it tells you that the money that's circulating in the banking system that's been created by the Fed is not being put to productive use. Because, the monetary velocity is the number of times each dollar bill changes hands, right? And so if you've got, and I don't know what the outright number is, but it's historically low. It just means that money is sitting there fallow, not being of productive use. And that's part of the reason why we're seeing, massive price inflation right now. It's obviously at least 3 to 4 times higher than the CPI is telling us that it is. So there's a couple things that low monetary velocity tells you. One is the economic activity is much lower than we're being told it is, because there's not any demand for that money by businesses to put to use for expanding their capital base, investing to expand their business, what have you. there's not new car dealerships going up, springing up. So, and that's what that chart is that I sent you. It shows you that the demand from the real economy for this money that the banks have to lend out has gone down at almost a 45-degree angle since July 2020. And that's the liquidity that the Fed is trying to keep in suspended animation, that excess liquidity there. And yet you have to ask yourself, why are they still printing money if there's already more money in the system than the economy needs? Mm-hmm. And that's why MV is so low.
So as we've seen a real increase in the mention of these central bank digital currencies, Dave, how do these tools fit into this system? Are they a possible route to expand the amount of control that the governments have over currencies?
You said it. I don't even know that I need to add anything to that, because that's exactly what it is. And it's coming. It's coming. It just remains, in my mind, it just remains to be seen, whether or not the populace embraces it or tries to fight it. But there's no question about it that there is a movement, and that's part of what Basel III is about. There's a movement that is starting at the BIS, and it's all the central banks, not just the Western central banks. The Eastern central banks are also involved in this. They're all developing their own digital currencies. China's actually beta testing their central bank digital currency in one of their provinces. I saw a news report about that a couple of weeks ago. Of course, it didn't make the mainstream media, but and that's what's happening. And if you've noticed, every major official at every major Western central bank, the EU, the ECB, Bank of England, the Fed, Janet Yellen, because that's basically the Fed in the executive branch of government, and several BIS officials have said investors should be prepared to lose all of their investment in Bitcoin. And they specifically refer to Bitcoin, but I think they're referring to all private cryptos, because I think at some point when the central banks are ready to roll out a central bank digital coin, digital currency, I think we're going to see them extinguish as much as possible private cryptos. And we're already seeing that in some countries. China's actually been cracking down quite a bit on private cryptos. So, and as you said, that it's an effort by the central banks, not only just to have tighter control of the money supply, but how and when people spend it.
To really be able to, let's say, affect that monetary velocity or whatever lever they want to pull in order to control their economy or their monetary policy, right? Yep,
that's exactly right. It's going to be their attempt to try and fabricate really what's essentially a centralized planned system in every country.
Mm-hmm. Excellent, Dave. Do you have anything else you'd like to share with us as we wrap up here?
Sure. I guess, at one point, because I've been getting a lot of complaints about, what's happening in the precious metal sector. And I mean, the last couple of months, the sell-off has been, oppressive, if not suffocating. A lot of people have thrown up their arms. And a lot of the people that have thrown up their arms are people who have been new to the sector, say in the last 12 to 18 months. Mm-hmm. And I really do not think that the cycle that we've seen, that I think is culminating right now and bottoming out, it's not any different from the same type of cycle we've seen over the last 20 years since I've been involved in this sector. And to illustrate that point, if you had put $1 in on December 31st, 2000, if you would put $1 in gold, $1 in silver, $1 in the S&P, $1 in the Dow, and $1 in the NASDAQ, that dollar would have appreciated 720% between then and now. The dollar in silver would have gone up 650%. The NASDAQ dollar would have gone up 595%. The S&P dollar would have gone up 320%, and the Dow dollar would have gone up 300%. And it may seem like, those are inordinately low numbers for the major stock indices. But I mean, most of the gain that we've seen over the last few years in the Dow and the S&P and the NASDAQ have occurred since March 2020. So I guess my point here is that, yeah, banks and central banks have the ability to slow down the price rise of gold and silver, but they can't cap it because gold and silver have been two of the best performing assets over the last 20 years. And the reason for that is as they keep printing more and more money, it devalues fiat currency, and it takes more of that fiat currency to buy an ounce of gold or silver. It's not that gold and silver are necessarily going up. It's that the money the currency that's used to buy them is declining in value. And so I think if you're patient and you have cash to invest and you start putting it to work over the next 4 to 6 weeks in this sector, I think by the end of the year, you'll be very happy.
Yeah, really having that a bit longer term perspective and, way to inform your short term thinking over a longer time frame like that is really valuable.
That's right. And what makes that statistic about gold and silver versus the stock market even more remarkable is that we know the central banks try to fight the price rise of gold and silver, and conversely, they try to inflate the value of stock assets. So the fact that gold and silver are still outperforming the stock indices over that 20-year period, despite the headwinds, and despite the tailwinds that the stock market gets, is just remarkable to me.
Yeah, absolutely, Dave. And yeah, that's a very, very interesting statistic here. Dave, of course, you're available at investmentresearchdynamics.com, and you have a very active Twitter feed at INVRES Dynamics. Dave, thanks so much for your time today.
Thanks for having me on again, Tom. It's enjoyable.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.